Lauren, you first. You heard what Harvey says. What do you think?
I am very sympathetic to Chris's arguments and sort of the arch of the year that he's putting forward, and specifically with the point that we have seen the impact of interest rates on multiples. We have not yet seen the impact of interest rates on the economy, on earnings. Investors tend to think of the markets as forward-looking, and markets do tend to lead the economy out of recession, which is one of the reasons why I'm sympathetic with an aggregate end-of-year call that looks okay. But in the meantime, earnings do not reflect recession until the data gets there. And we have not seen that element of the bear market yet. It's one of the most common questions I'm getting from investors is, isn't recession already priced in? And the answer is no.
Well, clearly, Joe, it can't be priced in at these levels where earnings are still projected to be. That's what Pisani and I were talking about over the last 24 hours. You know, you're still at 220. Maybe you got to go to 200 on earnings if you have a recession. But what's your view on what Chris Harvey says? Sell before May and go away, and you're going to have a pretty good correction coming up.
So the first thing I think about is portfolio management, because if you're utilizing the strategy of sell in May and go away, you're really a passive investor and you're just buying the index itself. You go over the last 10 years, it hasn't worked well. I talk with hundreds of advisors. They ask me the question all the time, should we sell in May and go away? Okay, the question really comes down to, I, by the way, believe that Q3 will be the weakest quarter from a performance standpoint in 2022. The problem that I have with it is, what am I selling and what am I moving into? And then I'm giving up on active management, which in fact I actually think is the right strategy in this environment. So if you go back 1 year, the market is basically flat, but there's been areas of the market where you've been able to outperform. And I think that is the more productive conversation. I think that you could look at technology and understand there's a disinflationary effect that right now is causing money managers to rebuild positions. So I'm not so sure I agree with you that you want to step away from that, because ultimately, Scott, at the end of the day, the question comes in, are you that good to assume the reinvestment risk and go back into the market? Because Chris said it himself. He thinks the market at some point will recover.
Sure, but you could also agree with that and say that, look, you know, technology has had just too big of a move. You're suggesting that maybe it's not time to
what's happening with
lighten up on tech.
Scott, what's happening now with technology is the fundamentals are finally coming back into play to support the rebuilding of positioning. And that's, as you said, that's AI. That's Apple, which is, you know, seeing services revenue potentially increase as we see strength in the mobile app. But ultimately, it's back to that disinflationary effect. Just look at the composition of what the market's doing today. What is gold telling you? Gold is telling you that we have this disinflationary shock at a far greater velocity than we ever expected. Biotechs are rallying today. Why? Because the market's realizing, okay, this is an economic climate in which we're going to have to search for growth. One last point. The premise that bad news is bad for the economy, I disagree with. Bad news is actually good for the market right now, because guess what? It signals peak yields, and the Fed, you're wrong.